Equity crowdfunding is the process whereby people, the crowd, invest in a company that is not listed on the stock market in exchange for shares in that company. Previously, only wealthy individuals, venture capitalists, and business angels could invest in startups. Equity crowdfunding platforms have helped democratize the investment process by opening the door to a larger pool of potential investors, the crowd. A shareholder stands to profit if the company will perform well in the next years, though the opposite is also true. So if the company fails, some or all investors can lose some or all of their investments. Equity crowdfunding is then risky by nature. It can take years to see a return. You're unlikely to receive dividends. There's no secondary market where you can easily sell on your shares. That is why the governments of most countries in the world and the European Commission itself provided or are providing regulations in order to protect investors. Usually, rules are set with two objectives. On one hand, to approve platforms and control the fairness of their operations, and on the other hand, to compel companies offering their shares to apply fair and not discriminatory conditions to small investors. In addition, several countries grant fiscal reliefs to reduce the investment risk, thus incentivizing it. A common question is how a small enterprise can stand managing even hundreds of small shareholders. Well, most regulations allow companies to issue shares with limited rights. An example, excluding the right to vote in the shareholders' meeting. Though we should consider an important upside for a company engaging a large number of investors. We're talking about marketing. Launching an equity crowdfunding campaign implies communicating, or better, selling the company's product or service to potential investors. Not necessarily people contacted will invest, but they could be interested in buying the product or becoming a business partner. Raising funds by launching an equity crowdfunding round is not just a matter of posting a description of the business, a few pictures and a video, and then sit back and see what happens. It's a full-time job for both the entrepreneur and for most of his team. Of course, the platforms are interested in bringing on investors, and they will do their job. But in order to increase the probability to quickly reach the minimum target and raise more, the company team should build itself the hardcore of investors. A typical timetable should look like this: planning, at least 1 month; pre-market, which means getting investors' soft commitment before the round starts, 1 month; running the campaign, couple of months; closing, 1 month. Indeed, the planning phase is the key one to increase the probability to succeed. First, set a realistic target. The minimum target funding should be what the company realistically needs to reach the next milestone. Realistic also means reachable, considering several factors such as how old the company is, how scalable the business model is in the midterm, how much equity the funders are likely to offer. Second, leverage an existing community. If the company team will have nurtured its network of people, clients, suppliers, business partners, social media followers, before the campaign goes live, they will be interested in investing in the business straight away. Additionally, an effort to expand the network before the campaign starts should be put in place. Third, carefully describe the business. Crafting a backstory of the business is always a good idea. but it's only a part of the puzzle. Investors' decisions are affected by emotion, but they also need to know if they're likely to multiply their capital. They're eager to know what are the company's strategic advantages, how big is the market, and how strong competitors are, how the company makes money, and how fast can the business model scale up the market. Video is important because it's the only opportunity the potential investor has to meet the entrepreneur and its team. Fourth, create or convert a PR and communication plan. If a PR and communication plan is already in place for the normal business, it should be partially mapped out specifically for the equity crowdfunding campaign. This is an opportunity to exploit the synergies between communicating at once, the product service, and the fundraising. Running a platform is a tough job. Revenues are generated only by a success fee, usually from 5 to 10% of the funds raised by each campaign. Rarely investors are charged. But costs are represented by a large number of quality activities. The tech development and maintenance, the marketing investments to build and grow up a large community of investors, the internal and external costs for selecting, evaluating, and onboarding the enterprises. Furthermore, lawyers should assist in order to ensure operations are fully compliant with the regulations and, in case, to finalize closings. To be profitable, then, a platform needs to generate a high number of deals closed, and its scalability derives from the ability to increase the average amount of funds raised per deal, which means, on the other hand, to increase the quality of the offerings and at the same time the community of investors. A platform can be generalistic if it hosts funding campaign no matter what their industry is. Worldwide, they are the majority. Conversely, vertical platforms are focused on a specific industry, like real estate or energy. It's worth running such a platform when, given the industry business model, the return on investment for investors can be planned with a reasonable accuracy, as well as the duration of the investment.